So I think what Mr. Diamond is saying is actually pretty interesting, and we're going to get into the weeds on this one, ladies and gentlemen.
Last month, that inflation may be stickier, rates may be higher than the markets expect. Is that still your base case? And what's kind of fueling that more cautious tone right now?
Yeah, so the way I look, remember in 1972 you felt great too, and before any crash you felt great, and then so things changed. So you got to look ahead. And I do think there are things out there which are kind of concerning we've got an eye on. And why are we doing so well? A lot of it's fiscal spending, and fiscal spending has a multiplier too. So I just think it may not come down that quick, and people may be surprised. So when people talk about, the market is kind of pricing a soft landing, that may very well happen. But, the odds at 70 or 80%, I would give them half of that. That's all.
Today, I want to focus on what I am seeing, where I think we are in the cycle, and just the things that could be coming in the very, very near future. Now, I don't want to scare anybody, so we're going to just put our emotions aside and look if there's any rhyme or reason of similarities that are taking place today versus past crashes or past opportunities that the market presented. So the first thing I want to talk about is actually the financial crisis, because I believe the setup is very, very similar from a technical standpoint, but I think the euphoric behavior is a little bit closer to the dot-com bubble. I don't think it's as exacerbated as a dot-com bubble, but I definitely think we're getting to pretty euphoric behavior where it could absolutely push higher. We could go to new highs, and we could absolutely see something similar to the dot-com bubble. But I want to take into consideration to what Jamie Dimon is talking about, that sometimes we could be feeling good, but there could be problems ahead. And I definitely think this is the case. And as most of you know, I turned more bullish when fiscal spending started taking place with the IRA Act, the CHIPS Act, and pushing student loan moratoriums once again. This was all fiscal stimulus, and that's exactly what Jamie Dimon's referring to. The problem with fiscal stimulus is that it could be inflationary going into this year, but with all that fiscal stimulus spending, it definitely led me to be more bullish up until probably the middle of this year. Now, I do think March will have a pullback, and we'll get into that in a little bit, but I think that pullback will be a short-term buying opportunity, a possible trading opportunity, and I think longer term, as we get closer to the end of this year, there's going to be some problems. But let's talk through some things here. First and foremost, I want to talk through this chart here, because if I took the numbers off this chart, this looks very similar to what we had during the pandemic, where we had that sell-off and that rip your face off rally that led us to newer highs in the market. Similar that's taking place here. Now, I just want to point out a few different things. We hit a new high in the market, and we pulled back substantially. Now, just to reiterate, guys, this is the 2007 through 2009 financial crisis, okay? So we've had that pullback roughly 30%, and we ripped up to new highs. So I want to talk about an ABC type pattern here, just so we can keep track of what we're talking about. A, we hit new highs in this market, so we'll say this is an A move here. B, had a 30% drawdown. C, to new highs, and then we had that substantial crash. Now let's go back to where we are on the chart today. Now the red line is the S&P 500, the 5-year chart, and the black line is the US dollar. So what I want to point out is the A move to new highs, the B 30% drawdown, and the C to newer highs once again, and that's where I do think we're starting a market top taking place. So when I look at these two setups, very, very similar with one another. Price-wise, obviously a little bit different, but the setup is very, very similar, where we get that drawdown, we think everything is okay, everybody comes in this market, we get that euphoric behavior, nobody wants to miss out on the recent run, and then we get that pull, kind of that rug pull that takes place of things that we didn't see coming, and this was the great financial crisis that took place. We're starting to see layoffs take place, and we're at a peak labor market that I think is very questionable, which we'll get into in 1 minute. Any one of these dominoes can actually fall here that could create a substantial pullback when we look at valuations overall, and that could even be just earnings starting to deteriorate at the end of this year. Are we being too optimistic on earnings? And we're trading at a historically high valuation when we look at the market, driven by your 7 names that everybody's talking about. Although the market is starting to broaden, but I specifically want to talk about where most portfolios are most likely lining up versus what's really taking place in the overall market here. On the equal weighted S&P, we can see that we're pretty much flatlined since October 2021, and then we fast forward to where we are today, basically March of 2024. And so even though the markets have been rallying substantially here, we're starting to see almost a double top forming in an equal weighted S&P. I do think we could go to new highs here. I do think there's more euphoric behavior still left in the market, and I think there's plenty of liquidity still left in the market to drive markets higher here. But I want to talk about the rhyming that's taking place with the financial crisis. The setup is eerily similar when we look at the S&P 500 from 2007 to 2009 to where we are today in recent rally that has taken place. Looking at the equal weighted market, to me, is telling us what the true performance of the overall market's doing here. And the breadth of this move has been extreme. The rapid speed of this move, definitely concerning to me, because now this is creating FOMO. It's creating a lot of euphoric behavior within the market. And as we can see, when we compare it to an equal weighted S&P, it's really only a few names that are carrying a majority of this move. And then when we bring in the Russell's telling us it's a different story here, as the Russell's basically on the cusp of still in bear market territory. It's had a nice move of hitting a low around 1650 and then skyrocketing up to right around 2100. And it's starting to run out of breath here, but still being down a substantial amount when we compare it, the SPY or the S&P 500. And so the Russell and the equal weighted S&P 500 are telling us different stories here. And once again, what are we noticing? We're getting that divergence on the Russell as well, where we're getting lower lows on the McClellan oscillator, but yet the Russell's popping to newer highs. And so are we getting irrational behavior on the Russell as well? And I do think the Russell will go a little bit higher. I think the equal weighted will go a little bit higher. And I also think the S&P 500, we've seen the dollar kind of kick back here, and now it's starting to creep up here. And the market's been ignoring the strength of the dollar, which I don't think it can do much longer here. The dollar is usually a pretty good indicator here when we get that big When we get a big movement in the dollar, we get that big down movement here on the S&P 500. As the dollar makes newer highs, take a look at the S&P 500. Has a inverse correlation to the dollar here. And we're starting to see that the dollar is finding a bottom here, which to me is bearish for stocks. So we're starting to see that the dollar is starting to make a new bottom here, and it's actually starting to tick up. And I think we could see the dollar reapproach its recent highs, which would then force downward pressure on the markets. And so we're starting to see a strengthening in the dollar. The markets are currently ignoring that, but we can see through history that the dollar is usually a pretty good indicator to how markets are going to respond, and which is telling me that this is probably not the most healthy of rallies, and the setup is looking a lot like 2007 to 2009, where we're getting that euphoric behavior in a lot of the tech names and a lot of companies that have received financial aid. And when I talk about financial aid, I'm talking about when we think about the chips outperforming. It makes sense that the chips are outperforming because the amount of stimulus that the chips maker have received through the government with the CHIPS Act. A lot of these chips are getting stimulus to build domestically, and the prices are starting to reflect that. So I want to make it clear, the market is still in a bullish trend, right? The trend is up. It's breaking out to newer highs, and you never want to short against this. But what I'm trying to show you is the setup is eerily similar. I do think we could draw all the way down to it and still be in somewhat of an uptrend here. But my biggest concern with this market is not just the strengthening of the dollar that I think is going to change the course of this market, but what I want to point out here is a few things. Number one is we have a substantially strong labor market, and that's basically the glue that's been holding everything together. And you would think that this would be a positive thing. I actually look at this as a negative thing. So we have a market that's heading up in an upward direction. We'd had substantial amounts of stimulus, and yet the labor markets are remaining stable. And that to me is a concern, because what I would rather see is that labor market started from a higher unemployment rate, and then we did stimulus, and then we created jobs, and then the labor market started to strengthen. But the fact that we're starting at such a low labor market tells me that it can only really go in one direction, and that would be unemployment actually ticking up, not down here. And that, in my opinion, is where we're going to really start to feel that monetary policy here starting to tick in by the time we get to the summertime. The reason why I was bullish going into the end of the year was not only fiscal stimulus that was being passed, but it was also seasonality. There's usually overhiring that takes place during holiday season. There is that behavior that takes place where people tend to spend more around holidays in the beginning of the year through the new year. They tend to receive a little bit more money because they are getting their taxes back. So there is some euphoric spending or seasonality spending that takes place that causes an overhiring and an overemployment that could take place here. So the fact that we're coming from such a low unemployment standpoint to me means that it can go in only one direction. Now, I have my thesis, and I think if we break above 4% on unemployment, this is going to be a bad signal here. We're currently sitting at 3.7, which means we don't need to move too much more to get to close to 4%. And you're thinking, well, 4% is historically low. And that is true, but the problem is the amount of hours worked a week have plummeted. So we really don't need unemployment to tick up that much in order to impact consumer income because they're not working as many hours. So we can see here that basically anything over 34 hours a week worked is usually pretty healthy. And we were pushing 35 hours a week worked, which means that I believe in 2021, when we had low unemployment and 35 hours a week worked, was possibly the strongest labor market we've seen. And what have we noticed? Well, unemployment is slowly ticking up, not substantially to even worry about, but the hours worked have been ticking down. And the combination of unemployment going up and hours worked coming down, to me, is actually a bad signal here when we consider the amount of fiscal stimulus that was pushed through the economy that's really not doing anything to the labor market, which is going to lead me to my next point here. So let's take a step back. The technicals are looking like 2007 to 2009, but could be a bull market happening here. But I tend to look at everything that's taking place, and to me, it doesn't seem like a bull market. When we look at the breadth of the rally, how the Russell has underperformed, how the equal weighted has underperformed, to me, this is getting closer to a double top where the overweighted stocks are pushing everything higher, which to me is actually more dangerous and is looking like the setup of 2007 to 2009 with a feeling of the dot-com bust. So now let's talk about the Federal Reserve balance sheet here. So we've had an immense amount of stimulus being thrown into this economy at the peak labor markets, and now labor markets are starting to soften as we look at the data. To me, this is a very, very bad sign because you would actually like to see labor markets even tighten with the amount of stimulus that was pushed through over the last 18 months, and that's not the case. It's actually softening. The Fed's balance sheet, to me, is a very, very large problem, which is going to keep rates elevated higher for longer. And I'm thinking we could get back to a 10-year yield that's pushing close to 4.5% to 5%. And the reason being is the massive balance sheet that the Federal Reserve has, toppled with the amount of debt that the government is issuing, and with us at peak labor markets, to me is not a good signal here. Because the largest purchaser of US debt has been the Federal Reserve, and they are not stepping in to buy our debt, and we are pretty much in a global recession, which means no other country is probably going to buy our debt either. So that means one thing, that yields are probably going to go up because of the pressure of the issuance of debt that's taking place and the lack of buyers on the market could spike yields a little bit higher, which will then put downward pressure on stocks once again. And that's where I think we can start seeing things break, whether it's commercial real estate or the consumer just finally giving up and throwing in the towel. When we look at the valuation of US stocks versus the GDP, the gross domestic product, we can see that it is 184%, and this has been a Buffett indicator. And when we look at a chart of historical or higher valuations to GDP, this tends to be an opportunity to take chips off the table. We can see that we've reached these extreme levels a few different times and have collapsed from these levels multiple times. And what are we doing? We're starting to reapproach extreme levels once again, to where I do think a collapse is in the cards here. It's just more of a matter of when. And as most of you can tell, I'm leaning more towards the end of 2024 into 2025 when everything starts showing itself. Now we have an unwinding of 3-month to 10-year treasuries, which is the yield curve inversion that I'm paying attention to. We're getting that W formation I've talked about before where, the inversion could have found a bottom here and we could actually get normalized yields, which then means the clock is absolutely ticking to where I think we're going to see the financial dysfunctions take place. Once this unwinds here, I do think we have a 6-month to 12-month window of when things can happen. So when I'm looking at this, I think by summer we can see this unwind, and by the end of the year to into 2025 is when we're going to really start seeing some serious problems here. But of course, until that time happens, markets can remain irrational and go much higher from here. I would just say understand the risk that you're taking on, especially when we look at the chart of 2007 to 2009. In 2007, the Federal Reserve talked about a soft landing, very similar to the rhetoric that we're hearing today. Everything felt good and the market hit new highs before the great financial collapse took place. And I'm not saying that's definitely going to happen. I'm saying there's a lot of setups here very, very similar. Everything from the inverted yield curve to the rhetoric that government officials are telling us, to running high deficits, to GDP growth versus stock market valuations. We are at very, very similar levels. That's making me pump the brakes and look at history and say, there is some rhyming here. It's not exact. It's never going to happen exact. There's a lot of rhyming taking place. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one.